Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 222 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about naked short selling. And you may say, well, what in the world is naked short selling? Well, we're going to get into it, but we have covered this topic of short selling before and exactly what short selling is. But I want to jump a little bit more into that and talk about the idea of naked short selling because there is an argument to be made for it being extremely prevalent in our markets today. And we need to know exactly what is going on in markets if this naked short selling has occurred. And this may have a lot to do with our discussion of GameStop stock and AMC stock and all the meme stocks out there and all the short squeezes that they've been going through. So stick around to learn more about that and much more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to anything that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then even further, if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just go to any of my social media sites and send me a message on Instagram, Twitter, Facebook, any of the major social media sites, and send me a message and ask for financial coaching services. And I can help you. We can work one-on-one in building out a financial plan for your life that will help you to reach your financial goals and ultimately reach long-term financial freedom. So before we jump into this idea of naked short selling, right, let's talk about short selling in and of itself. Okay, what is actually happening when a short sell occurs? And why is it relevant to what we're talking about in any of the episodes we've talked about recently? Well, when it comes to short selling, all that's happening is that you have somebody in the market that believes that a stock or any particular security, but typically a stock, will go down in value over time. They believe that it is worth less than what it is trading for today, and typically they believe it's worth substantially less than what it's trading for today. Okay, so they will take a short position. Now, before we get into a short position, a long position, right, the opposite of the short would be to purchase the shares, right? If you own shares of stock, you are long those shares of stock. But if you are short, right, you are going to take the opposite position. So long, you would benefit from the stock going up in value, but if you're short, you benefit from the stock going down in value. So how does this occur? Well, if you're going to short sell, what you would do is you would borrow shares from a broker, right? You would sell those shares to somebody who is buying in the market, right? And then you would receive cash for the fact that you sold those shares. All right. Well, the fact that you borrowed shares from somebody, eventually you are going to have to return those shares to that individual or to that investor, right? Well, you borrowed the shares, you sell the shares, right? You're sitting there, and what you do is you wait. And you wait for the shares to go down in value. And if the shares go down in value, then what you will do when you get to some point where you're like, okay, I don't know if it can go down in value anymore, you will repurchase shares from the open market at the lower price, return the shares to the individual broker that you took it from, right, that you borrowed those shares from, and then you get to keep the difference in price, right? Because instead of, in a general sense, when you're buying shares of stock, buying low and selling high, what you're doing here instead is you are selling high first and then buying low later, and you're making the difference in those two share prices, right? So that is short selling. Well, then how does short selling differ from naked short selling? Okay, well, with naked short selling, right, a seller sells stock that they don't have to a buyer who sees it in their account electronically, right? So same set of circumstances where somebody is betting on a stock to go down in value, and so they are selling, right? They're selling shares. Well, they're selling shares to a buyer who sees it in their account electronically, but it has not actually been delivered to them. Okay, the buyer gives the seller money for nothing that was delivered, right? So ultimately, what happens is these electronic trading platforms, right? They have so many shares going one way and another all the time, right? That shares can get jumbled up, right? And you can short something that doesn't actually exist. right? Yes, the stock exists, right? Yes, the company exists, but the actual shares of stock that you shorted may not actually exist. Okay, naked short selling is the illegal practice. It is an illegal practice. That's very important to note first and foremost, that this is not legal, right? Short selling is legal, right? You can short a stock all that you want to, or within the bounds of the SEC regulations, right? But it is illegal to naked short sell, right? So naked shorting is the illegal practice of shorting shares that have not been affirmatively determined to exist. Ordinarily, traders must borrow a stock or determine that it can be borrowed before they sell it short. So naked shorting refers to short pressure on a stock that may be larger than the tradable shares in the market. So they don't necessarily confirm that they can borrow the shares that they are shorting. They just short, right? And so they are getting exposure to this particular stock and this particular stock's movement without actually having the shares outstanding in order to do so. Now, how does this come about? What makes this so prevalent? Well, like I said, there are so many shares of stock that change hand every second, every minute, right? And these electronic trading platforms want to provide liquidity, right? They want there to be markets that are able to take care of buyers and sellers and give them good prices for the shares that they want to buy or sell, right? So what they'll do is they will allow these short sellers or even buyers to purchase or sell things that aren't actually available at that given moment, because they just assume it'll be available sometime in the future. But with short selling, this can become problematic because, like I said, you can end up having the short pressure on a stock that is larger than the tradable shares in the market, meaning that you have more shares that are shorted than you have shares outstanding, which is absolutely ridiculous, right? And this really ties in directly with, when we're talking about the Reddit investors and the Wall Street bets people and the people who invest in GameStop and AMC and things like that, right? They looked at these companies and GameStop had more short sellers outstanding than they had shares outstanding, right? They had more shares shorted than they had shares outstanding, which is absurd, right? It's absurd that this actually is occurring. And if that happens, right, then that means that naked short selling is occurring. And if naked short selling is occurring, it is illegal, right? And so the SEC needs to do something to crack down on this naked shorting. Now, this was made illegal after the financial crisis of 08-09. Naked shorting continues to happen because of loopholes in rules and discrepancies between paper and electronic trading systems. Now, again, naked shorting takes place when investors sell shorts associated with shares that they do not possess and have not confirmed their ability to possess. If the trade associated with the short needs to take place in order to fulfill the obligations of the position, then the trade may fail to complete within the required clearing time because the seller does not actually have access to the shares. The technique has a very high risk level, but has the potential to yield high rewards, right? While no exact system of measurement exists, many systems point to the level of trades that fail to deliver from the seller to the buyer within the mandatory stock settlement period as evidence of naked shorting. Naked shorts are believed to represent a major portion of failed trades. So if you just think about it in terms of this particular example that I'm going to give, right? Let's say you have a title on your home, right? You have a title and you could go and you could make 100 copies of that title. You could make 100 copies of the title of your home. Then you could make the decision that you wanted to sell your home, but you're going to do it 100 times, even though there's only one home, right? So the other 99 would be like naked short selling your home because there is no underlying share. There's nothing there for you to actually borrow and then sell. You are just selling this piece of paper. You're selling this right to own something that doesn't actually exist. Right? So you could see in that situation how you would have a bunch of angry buyers, right? You would have a bunch of angry individuals, and you would have a bunch of individuals who, for lack of a better term, were screwed out of their money. They would not have the asset that they thought they could get for the money that they thought they paid for it, right? Because there would be no underlying asset. You would just hold this title, and this title would be absolutely useless because there was no underlying asset, okay? So you can see how this can be viewed as just stealing, right? It's illegal for a reason, and that's because in the financial crisis, 2008, 2009, a lot of naked short selling was going on, not just in stocks, but in things like credit default swaps and collateralized debt obligations, right? And you had a lot of people who were shorting these instruments without there ever being an underlying instrument to short. And it really permeates through the economy. It permeates through the world of business because you are doing this. You're able to take these positions without these positions actually ever being available, which actually has a negative impact on the value of whatever asset you're sitting there trying to short, or you're sitting there trying to bet against. Okay, because naturally we know when there's more short sellers out there, that's going to put negative price pressure on a particular stock. That's why when it comes to GameStop and AMC and these other meme stocks that have come up, that people have looked and they've gone, oh, well, these are so heavily shorted. Let's run in and buy up as many shares as possible to put positive price pressure on the stock, right? And that positive price pressure will push these short sellers out. And not only is it going to push out legal short sellers, it can also push out illegal short sellers, right? And it will push all these short sellers out and will allow the stock price to rise and rise, because when a short seller leaves their position, what they're doing is they're repurchasing the shares, right? They're buying the shares back. Okay. And when they buy the shares back and return them to the broker, now, obviously, in a naked short, there is no share to buy and return, right? But if you buy a share and return it to a broker in a legal short, right, that is going to increase the share price along with the individuals who are buying the stock already. And so it's just going to push the share price higher and higher, and it's going to cause what we call a short squeeze, right, where a lot of the shorts want to get out because they are losing money when the stock price increases. And we understand that. We've talked about that when we've talked about AMC and GameStop, right? But we haven't talked about this naked short selling, because technically, if you are naked short selling, right, meaning there is no share that you borrowed from a market maker, that you borrowed from some broker. If you didn't borrow the share, but you actually were able to make the sell, right, and receive the cash for making the sell of that non-existent share, then you don't have to return a share to anybody, right? There is no share to return to any market maker, to any dealer, right? There is no share to return. If there's no share to return, then you can sit in that short position forever, and nobody's going to be able to force you out of that particular short position. That is why something like this is illegal, because it is so shady. And if anything was learned from the financial crisis of 08-09, it was that financial instruments, if given the free rein to do whatever people want to do with financial instruments, they can do some pretty shady stuff. Now, what kind of impact can naked shorting have? Well, naked shorting can affect the liquidity of a particular security within the marketplace. When a particular share is not readily available, naked short selling allows a person to participate even though they're unable to actually obtain a share. If additional investors become interested in the shares associated with shorting, this can cause an increase in liquidity associated with the shares as demand within the marketplace increases. Okay, now, naked short selling was a focus of regulatory changes in 08, in part as a reaction to the piling on of shorts on financial giants of Lehman Brothers and Bear Stearns, right? Because both of those companies failed, and a bunch of people were piling on, and a lot of naked shorting was occurring. Now, there are regulations when it comes to naked short selling, right? Which is why it's so crazy that this stuff actually goes on. But there is regulation to act against it. So the SEC, the Security and Exchange Commission, banned the practice of naked shorting in the United States in 2008 after the financial crisis. The ban applies to naked shorting only and not to other short selling activities. Prior to this ban, the SEC amended Regulation SHO, right? That's this particular regulation on short selling, right, to limit possibilities for naked shorting by removing loopholes that existed for some brokers and dealers in 2007. Regulation SHO requires lists to be published that track stocks with unusually high trends in failing to deliver shares, right? That's a big thing when it comes to the naked shorting market, is these failing to deliver shares, because these systems will be able to catch when there was no share delivered, right? But it's actually very, very difficult to do. Now, Some analysts point to the fact that naked shorting inadvertently might help markets stay in balance by allowing the negative sentiment to be reflected in certain stocks' prices. If a stock has a limited float and a large number of shares in friendly hands, then the market signals can theoretically be delayed inevitably. Naked shorting forces a price drop even if shares aren't available, which can in turn result in some unloading of the actual shares to cut losses, allowing the market to find the right balance. Now, this is a very interesting argument for naked shorting, right? And some may say that this is a reason that naked shorting should exist if you believe in free markets, because if you have a bunch of people who are just diehard shareholders of a company and they're sitting in there and they're just going to hold, and some may make the argument that a lot of the GameStop and AMC investors specifically are jumping in to just hold when there is no reasonable basis for the stock price that these particular companies have. And the argument here is that if you were to allow short selling, right, in a naked way, right, where there is no share delivery, you're just allowing negative price movements of the stock without there being any, actually selling or buying of actual shares. Right? Well, what that would do is that would push out people who are just holding a stock for no good reason. Right? So it would actually allow the market to come to some sense of actual value, which is a very good argument for why naked shorting may actually be something that needs to occur in markets, because otherwise you can get people, and it is going to be interesting to see how this plays out. You get people in things like AMC and GameStop, which don't have any reasonable basis to be valued as heavily as they are today. And you get people just sit in there and keep those high valuations up, even though there's no reasonable basis for them, right? And they can just hypothetically sit in that stock forever, or those stocks forever, and not allow any negative price action that's too crazy. Right? But naked shorts, if there could be a lot of naked shorts that jump in, right, they could push the price down and force some of these individuals out. They could force these people out of these particular stocks, and that would be actually beneficial to the market, because the market would be able to come to some determination of price that is actually based on reality, that's based on the fundamentals of the company, and not just based on market sentiment at a particular time, or the sentiment of a small group of investors that wants to prop up a stock over a period of time. Now, per SEC regulations, participants in naked short selling activities can be charged with a crime. In fact, in 2014, 2 Florida State University professors were charged with using a naked short selling strategy in 20 companies to earn more than $400,000 in revenue. In 2018, there was a widespread speculation that naked shorting was endemic in the cannabis sector, as shares were highly sought after and thus limited, but short interest continued to grow regardless, right? And so I think now, right, the reason that it's relevant today is because the SEC is looking into some of these meme stocks. They're looking into some of these companies that are heavily shorted and shorted at more than the actual float shares that they have outstanding. And they want to know why. They want to know why that is the case. They want to know why you are able to short more than the particular float that is outstanding. Now, there is another argument for the fact that this reported number of percentage of shares outstanding that are shorted is so high, and it's not naked short selling, right? So there's an article out that says why naked short selling is not as prevalent as you think, right? And this is the argument that is given, right? AMC is a stock that has been heavily shorted, and even though the shorts might get squeezed, there really isn't a lot of naked short selling in practice. So there is this argument for what we call rehypothecation, right? When a short seller opens a 100-share short position, he or she must first borrow 100 shares of stock. Those shares are then sold to a buyer who opens a 100-share short position. That buyer can then turn around and lend out those shares to another short seller, which can open up a second 100-share short position on the same 100 shares of stock. Because the brokers aren't required by law to tell buyers their shares were borrowed by the seller, the chain of rehypothecation can continue indefinitely and has sometimes resulted in certain ETFs temporarily having short interest of more than 1,000%. All of this is regulated by Regulation SHO by the SEC, and enforced by FINRA, which requires that brokers report all their trades that failed to clear for one reason or another. But the argument is that the list doesn't show this, right? There's very little naked short selling, says Tim Quast, founder of Market Structure Edge. That's not the problem. The people who are trying to look for naked shorting here don't understand the way the stock market works. It's not naked short selling, and it's not illegal behavior that's leading to this. right? So they are basically saying that it's this idea of rehypothecation where you have shares that are changing hands and doing so in a legal way, right? But they're not being marked down in the way that they should because there's no requirement for brokers to tell buyers that their shares were borrowed by a particular seller, right? And so given that that is the case, then you end up with the number of shares that are being shorted that is greater than the total number of shares that is outstanding for a particular stock. Now, this is a decent argument, right? But the argument for naked short selling is actually very hot. It's actually very real right now. It's something that a lot of people have been looking into, including the SEC. So we can't understate the importance of such an investigation, right? This could be something that is really making its mark in markets today. But then the question really is it good or is it bad? Right? Is it extremely negative? Is it something that needs to be cracked down on? Or is it something that should be allowed to continue to occur? Well, you can really look at it through two lenses, right? If you are going to allow naked short sellers, right, in the market, if you're going to allow them, then what you can expect is that short sellers can band together and they can pull stocks down. And they can pull stocks down in an extremely, extremely fast way. And they can pull stocks down and keep them down for a long period of time. Okay, but if you don't allow shorts, right, if you don't allow these naked shorts, then you can allow a bunch of investors to jump in and take long positions in a stock and just camp out in that stock over the long term and not allow the short sellers to bring any negative action on that particular stock. So there's positives and there's negatives on both sides. But what I would say is, we want shares to be accounted for. There's a reason companies have a certain number of shares outstanding. And I believe that if you're going to make money off of a firm's shares, it should be based on the fact that you actually either had custody of those shares at one time or you currently have custody of those shares, right? I believe that if you are going to short something, it should be because you actually sold shares that were real, right? These shares should actually be accounted for in the market, right? Just based on a moral judgment, a company, they have a certain number of shares outstanding, and that's the number of shares that they chose to have traded at any given time. And if more shares than that are being traded and more shares of that are being shorted and pushing their stock lower and lower, then that's not fair to that particular company who doesn't actually have that many shares outstanding, right? So even though you can make a good argument for allowing short selling in a naked way, right, that does not mean that it's beneficial to the company. And that does not mean that it's not wrong because the company didn't want that many shares outstanding in the first place. Okay, so that's something that we have to take note of. Not only did the company not want that number of shares outstanding, but the price of the stock is not adjusted for a new number of shares outstanding. Every time a short occurs, it's going to have a more negative effect on the stock, right? Because selling it at a higher price is going to have a larger effect downward on the particular stock, right? And so as shorts pile in, right, as legal and illegal shorts pile in, then it is going to have a detrimental effect on the stock price, which of course is not good for the company, right? I think, if you're going to profit from shares of stock, so if you're going to profit from selling shares and shorting in that way, if you're going to profit from the upside of a share of stock, then you should own that share of stock, right? There shouldn't be this fact that you actually were never delivered a share of stock and yet you got the upward price appreciation. No, you need to own the share of stock. You need to be a part owner in order to get price appreciation. You need to be a part owner in order to actually get a piece of what's going on within the company, right? This is extremely important, I think, right, for the morality and the ethics of markets, right? And some people say that short selling needs to go away altogether, which I don't necessarily agree with because short selling allows us to have a more balanced market. If you have buyers and you have short sellers, right, you have people who are betting for and people who are betting against, and the people who are betting for typically far outweigh those who are betting against particular stocks, right? Then that can allow us some sense of balance. But the problem here is that a lot of the shorting is not done by individual investors. It is done by institutions, and these institutions can get to this place where they are naked shorting, where they are not actually having the shares delivered, but they are still getting the price movement that they want, and they're able to push a stock down in the way that they want to do so. And that's kind of why a lot of the investors in AMC and GameStop, they chose to take the positions that they did because they were trying to force the hedge funds out. They were trying to stick it to the man in a certain way when it came to these hedge funds that were continuing to short, and maybe, I'm not saying they did or didn't, but maybe even shorting in an illegal way. And so this is something that is happening in our market, maybe in a small capacity or maybe in a very large capacity. We do not know, right? But it is something that we need to be aware of as investors. It's something that we need to know that actually exists. And if anything, right, this practice can kind of make you feel like the markets are not fair, right? And make you feel like, if these large institutions have the ability to do something like this, then it's not fair to the retail investor. And I would be in that boat with you. I would tend to agree with you. I believe that this is not necessarily fair to the retail investor, but at the same time, as long as the rules are what they are, or as long as the regulation is not being enforced, you still have to play the game of investing, and you have to do it based on the rules that are being played with in the market at the given time, right? So what I believe here is that if we are good long-term investors, right? If we know what we're investing in and we're investing in companies that we believe in over the long term, right? And we have some fundamental basis by which we can make our investment choices, then naked short selling should never have too much of a negative effect on us, right? Even though it may occur on a particular stock that we may hold, if we hold that stock for good reasons, for good fundamental reasons, then we shouldn't care if people want to take opposite side of the coin positions, right? Let them take those opposite positions and let them be pushed out by the fact that the company is actually profitable. And let it be pushed out by the fact that the company actually knows what they're doing and is not going to go down substantially in price over time, right? So if we're good long-term investors, this should never really come into play with us. But if we are trying to trade and if we're trying to invest in things that are extremely speculative, like GameStop and AMC, if we're trying to make short-term profits and not worry about the long term, then naked short selling might be something that you're really worried about, and maybe something that you really care about. And that's why it's such a topic of contention now, because there are so many short-term traders and there are so many individuals that are trying to make quick bucks on these large pops in price in stocks like GameStop and AMC. And as long as there are naked short sellers out there, it's going to be harder to do this. It's going to be harder to make the profits that they want to make, right? And so they will cry about the fact that there are naked shorts out there. But if those companies actually had legitimate value that was being revealed by their stock and being revealed by their stock price, then this would likely not be such a big deal. First of all, because people wouldn't want to short sell something that's going up in value, right? And then two, because if people did short sell something and it did go up in value, they would be pushed out of that short position, okay? So overall, hopefully this helps you to better understand financial markets. This is one of the goals that I have for you guys, even though this is a personal finance show and I'm trying to teach you and educate you and push you towards financial freedom over the long term. I think it's important that you understand financial markets and you understand what's going on in the short term, and you understand that if you hear these certain buzzwords, you know what they mean, you know how to interpret what is being said, and you can have thoughtful opinions and make thoughtful actions based on what is going on in the market at any given time. And you can be an informed investor, know what you own, and be able to stay away from things like short selling and things like naked short selling overall. So hopefully this helps you. Hopefully this helps your understanding of financial markets, and hopefully we can build on that understanding in future episodes. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just message me on any of the major social media sites, Twitter, Facebook, Instagram, any of those, and ask me about financial coaching sessions, and we can begin having financial coaching sessions with one another, and I can help you to push towards your financial goals. I can teach you about different things in financial markets and personal finance, about your debt, about investing, all different types of things, and I can help you to push towards your long-term financial freedom goals, which is ultimately what I'm trying to do on this show. I'm trying to push you towards action. I'm trying to push you towards good long-term financial decisions, and I can help you do so via my financial coaching. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.